So again, thank you for joining us for the seminar this evening. As a brief introduction, my name is Jean Zhou. I'm the broker and owner of Perisson Real Estate. I think most of you have heard this before. But as the slide says, Perisson, we say it rhyming with Harrison. It comes from the Greek word for abundance. And this is really the core principle upon which I wanted to build this business. I truly believe that we live in abundance, especially in this area, and especially in our generation. I think we definitely do live in a lot of abundance, and that if we work toward the good of each other, then all of us can thrive together. So these seminars are an outgrowth of this belief, and we really want to be a valuable resource for our company, for our community. We've been hosting these seminars almost ever since the beginning of the company, and I've really enjoyed hearing from many of the speakers on important topics for real estate, some not as important but fun topics, and as well as I've really just enjoyed the chance to be able to meet many clients and community members through these events. Tonight's topic is pretty substantive. I've been doing a lot of research into it, so I'd like to just go ahead and launch right in, and hopefully it'll all come together and make some sense. But I'm only going to be able to scratch the surface of what's happening. To try to say we're going to cover all of 2019 and 2020, very ambitious as a project, but hopefully we'll be able to provide some useful overview of what the market's doing. Am I in your way, Chris, or are we? Okay. So I'm going to start out with an outline. So we'll start out, as usual, with the introduction, and then the 2019 market. We'll do a brief overview on that. And then 2020, what the outlook and the predictions are, and then practical implications for homeowners, home buyers, investors, some question and answers. Since we're a small group, please feel free to just stop me in the middle and ask questions along the way so that we can, because I think we can afford to do that. And then we'll have some announcements. The bathroom code is 1700. And the bathrooms are right outside these doors, so go anytime. So I'll launch right into the 2019 market overview. Last January, this is a slide that we had at our seminar last January, and I'm not sure who was here then, but recession, that was the big word at that time, possible recession. And it said, economists said in a survey that there's a 25% chance of a recession in the next year, meaning within the 2019. And then 56.7 expected a recession to start by 2020, an additional 26.4% by 2021. And you also have actually the slides in your packets if you'd like to follow along. Interestingly enough, that number has changed along the way, and now people are saying, well, maybe it'll be more like either later this year or 2021 or even further out. Even if we have one, it'll be more of a correction, not something like the likes of 2008. And definitely it's not going to be triggered by housing, which was the big issue in 2008. So, but I just thought this would be interesting to look back and go, that's interesting what was being said at that time. I'll start out with the national market. This is the U.S. economic performance, and this slide is taken from the economic outlook that was presented by Leslie Appleton Young, who is the chief economist for our California Association of Realtors. This presentation she did in September, and so some of the figures will be a little bit more of a projection toward the end of 2019, but they held fairly close to what actually happened. The U.S. economic performance, the GDP, U.S. GDP, the gross domestic product, which is the total value of goods produced and services provided in a country during the year, that has stayed fairly steady since 2015. So 2.6, 1.6, 2.3, 2.9, and 2019 projected at the end was at 2.2%, and I believe that's about where it ended up. The non-farm job growth came down to 1.3%, and then unemployment came down to, and this is historical, 50-year historical lows, which is 3.7% was the projected, and that's about where it ended up. So we're at 3.7%. Some people are calling it underemployment even, because we don't have enough people to fill the jobs that are out there. And then CPI, which is the Consumer Price Index, is at 2%. So it's stayed fairly steady for the last few years. And the real disposable income percent change is at 2.8%. So these are big numbers. I don't have time or the expertise to go into all of them, but this is just to give you an idea that we've been holding pretty steady for the last 3 years in most of the indicators. This is the monthly house price index for the United States, and this is published by the Federal Housing and Finance Administration. This goes all the way back, if you look here, all the way back to 1991, January. You see it going up to the 2006 time period, and then dipping in the 2008 period, and then when we hit about 2012, so this is the last recession that we had. When we hit 2012, we've had a steady incline ever since then. And that has not stopped since 2000, even up to 2019. So that's one chart. This chart, I actually have it expanded in your folders so that you see a full sheet, because this is something that people really like to take a look at, which is the 4-quarter price change by state throughout the United States. The range goes from the white, the lighter colors at 1.9%. So you see one smack in the middle, which is Illinois, and then goes up to 11.6%, which is Idaho. So I have that also broken down here, and you'll see another chart that has front and back, the features for each state. I like to provide these because they're interesting to people, especially who are thinking about purchasing property outside of the state or moving somewhere else. Interestingly enough, so the US overall for the last 4 years had a 1-year change of 4.94%. And I zoom in here. So 4.94% over the year. Since 1991, 174.44% increase. And then California, we've actually, a few years back, we were actually in the top 20. We're in the top 20 ranking. Now we're down to 40 out of 52, which is not surprising because our prices are so high. So these are percent price appreciation. So the amount that you have to appreciate is going to be quite a bit more. And even then, we had a 4.05% 1-year change. And then since 1991, 192, so almost 200% increase that we've had. So 3 times of what it was in 1991. So that's been very, very strong and continues to be. State of the state. So California, again, breaking down some numbers. So the non-farm job growth was projected to be 1.5% at the end of 2019, which is fairly steady with the last 2 years, previous 2 years. Unemployment is a little higher than in the country. It's at 4.3% ending, still relative, still very low, healthy numbers. And then our population grew by a little bit, by 0.5% to 39.9 million. So that's our population in California. If anybody ever asks you, that's where we're at. This is interesting because we're actually experiencing a lot of out-migration as well. People who are saying, I can't take this anymore here in California. The prices are too high. The highways are too congested. I want to go somewhere else. And so I'll be showing some slides later of a lot of people who've been migrating out, but we still have such an influx coming in that our population continues to increase. The California median price went to all-time highs in August of last year. So the median sale price, for those of you I'm assuming all of you know, but the median sale price basically means the same number of houses sold above this price as below it. So that's the way that we look at it. The median sale price for California, the beginning of this graph starts at 2005. You see the dip at the 2008 level. And then it stays low in the 300,000s level, and then until you get to 2012, and then it steadily increases over time. And you see it going up to, and as of August of last year, it went to 617,410 is the median sale price. Yes.
Are you going to share the slides?
I am going to share the slides. Yes, and we also are recording it. And we'll have it on YouTube available as well, so we can share all of that. And you also have a copy in your packets, so you can follow along with me if you'd like. It's a little bit smaller, but so you have the median sale price has been steadily increasing despite, and that was what many of the forecasters predicted last year, is that we'll continue to have slow growth. It won't be as high, it won't be as fast as it has been, but we will continue to see it grow. The number of active listings in August of 2019 had the largest drop since 2017. So if you start out, it starts out here with 2015 levels. Until all the way up through the beginning of 2018, we actually had less active listings on the market, and so we did have the inventory shortage. We did have through 2018 and part of 19 started getting a little bit more of a add-on more active listings coming on the market, and then it started dropping again. So we continue to see inventory levels actually still quite low, which I'll go into here. This is the inventory index. It's also, this is again from the presentation by the California chief economist. But this inventory index is the same as what we call the months of inventory. And basically what this is saying is, if we were to sell all the houses that are currently on the market now, how long would it take? So if we're at 2 months of inventory, that means if nothing else came on the market, we completely run out in 2 months. Traditionally, it's, anybody want to say what's a balanced market? People who've come? 6 months, yay. Traditionally, 6 months is considered a balanced market. If it's below, then that's considered a seller's market, right? If it's higher than that, then it's considered a buyer's market. So if you see 2005, we started at below 5 months of inventory, and then over the 2008-9 period, it actually increased. And then after that, and this is within California, we've seen it just pretty much stay under the 5-month level, which is a seller's market, and it stayed that way. And if you look, if you're comparing year over year, in August at that time, August of 2019, we're at 3.2 months inventory for the state, which was down from 2018, the year before, which was at 3.3 months. So fairly low. Again, is a buyer's market or a seller's market? Seller's market, right. Time on market. Time on market actually over time period actually went up as the market was ending the peak season. So in August 2019, it came to 23 days. 23 days, if you think about it, that's 3 weeks, a little over 3 weeks that it was on the market, and this is for California as a whole. So still, fairly good. And then finally, this is a look at the number of sales. So as of August 2019, there were 406,000 units that were sold. You can see in 2005, we saw close to 600,000, and then it dipped down in end of 2007, and then we had our recession, and then everything has been just pretty much staying steady, staying flat all along. And this is with a very strong economy, with interest rates that are incredible, and we'll go through those, with population growth, still the sales have been fairly flat. So if you hear the news, sometimes they'll be talking about how sales are flat in California, and people go, oh no, the market, something's going on with the market. It's not necessarily that, it's just there's not inventory. And I've been saying the same thing for I think the last 3 years, but that's really what has been limiting us for several years. So taking it local, so I'm for the sake of time, I'm just restricting this to single-family homes in San Mateo County. If you are interested in San Francisco or Santa Clara or any other areas, please feel free to shoot me an email, and I'd be happy to send you over the information for those counties as well. But this is, first of all, a look at the median sale price. Again, that means all the homes, the same number of homes sold over as sold below that price. And this goes back to 2006, because that's how far my MLS will let me go. So if you look at the beginning, we start out at about 850,000 was the median sale price. It increased to a peak of a little over 1 million in July of 2007. And then it dropped drastically in 2008, and then to a low in January 2009 of 545,000. So that's the low that we see here. And just as an aside, I started real estate at the beginning of 2008, so I had a really good time. But I was told at the time, well, you're getting in at a good time because you're going to learn it right before it goes crazy. And sure enough, things have gone up ever since. And it's been great for my clients who've all bought during that time period. But it's been a challenge as well to really keep on top of the market and to know what I'm doing. But anyway, so since 2009, at the $545,000 low, it's continued on a rise. So up and down, and then the penultimate peak was in April of 2018. So that's this peak right here was in 2018. That was where $1.74 million as the median sale price. And then we thought, okay, this is it. That's the peak, and it's going to start going down. We actually exceeded that peak in May of 2019, $1.765 million. And just thinking about that is incredible. This is 2019 specifically, so I just nailed it down to the whole year, narrowed it down to the year itself. We started at 1.4 million as a median sale price, peaked in May, like I mentioned, at 1.765 million. And then in December, we ended at 1.475 million. So we basically ended up almost where we started, besides the peak, and then it kind of slowly went down. So, yes?
Could we expect that same kind of seasonality pretty much every year?
Pretty much every year. Yeah. That's what we've seen. So usually you'll see a peak in April, May. So May was actually a little later than usual. So we'll usually see it in April. But April, May, and then it'll come down a bit during the summer, and then you see a little bit of a peak toward the end of the year again. So this one also came up in November. That was a little late. So usually we'll see more of a peak maybe September, October, kind of a smaller bump. And then end up just depending on where things go. But in this case, we ended up almost where we began, which is interesting. So, and just to put it in perspective, though, the median sale price for the United States, anybody have a guess what that is?
230.
Oh, you're really close. Okay, I shouldn't give it away. Anybody else? Higher, lower? Higher than 230? 300. Okay. Any other guesses? 230, 300, any other? 270. I'm getting it. 274, 274,500. Our median sale price is 1.475 million. For the state, anybody have a guess or I think I mentioned it earlier, but did you catch that? What's the median sale price for the state in December of 2019? 615,090. So 615,000 for the state, 274,000 for the whole country, and for us is 1.47 million. So again, when we're talking about abundance and that we're living in, it really puts things in perspective when you think about it.
And our 4% is better than others.
And our 4% is going to be significantly better than others. So when we say 4% appreciation, that's coming off of a $1.47 or $1.5 million median sale price, as opposed to if you're starting at 270. So quite a difference. The average price per square foot. So this is, again, since January of 2006. We started out somewhere around 600. Went down to about 400, a little over 400,000. There's this one blip there, and this always drives me crazy, but what it is one agent, and I had to track it down. I finally found it. One agent recorded in the MLS 1 square foot, and the price was 1.5 million. So it made it 1.5, anyway, so it skewed all the numbers, right? So that's why we have that one, just ignore it. For the most part, though, you've seen it going up and up and up. And then now it's been, ever since 2018, we've been hovering around $1,000 a square foot. So that's the average. Again, that will differ depending on where you're at, which city you're at in particular. But so it can be a little bit more, it can be a little bit less, just depending on where you're at. But that's still, for a countywide, that's still very high. Sale to list price ratio. So this is the ratio of what was the final sale price compared to the asking price when it was sold. The dark line that you see in the middle, that's 100%. So you see for 2006, it was pretty much similar to the asking price, and then it dipped a little bit in 2008, and then it kind of went up and down, and then since then, since 2012 to 2018, it just went shooting up. And so up to the peak, which was at some point 110%, over 10%, 110% of the asking price. 10% over the asking price, right? And then since then, toward the end of last year, we've seen it more averaging still a little over 100%, but more in the 2% range or so. And this is, we're coming to see, definitely we're seeing less multiple offers happening. So there used to be common where I would see 20 offers, 30 offers, something like that, and then that went down to 5 or 6. Now, every once in a while, we'll actually see houses where they only had one offer. And so there's not as much negotiating happening. And so that's been going on. But we are still also seeing houses that are going way over asking. So it's very important to know where you're at. But it's interesting that we're seeing it pretty much stay over the 100% range. Days to sell. So this is from when you first put a house on the market until when it actually, you have an offer that's accepted. So the peak you see here went at, it's 65 days in January of 2008 was the peak. That took 65 days to sell. And then it went down. So even though the recession was going on, there were a lot of short sales and bank foreclosures and things like that. And the foreclosures actually went very quickly because the banks would price them very low. And then they would just put in an artificial date of, at least a week or at least 2 weeks before they accept offers. And they started this whole bidding war, I think, phenomenon more than anything else. So we did see that. And then 2012, everything just came down. So the days to sell remained pretty much under 20 days. We did see in 2019, toward the end, we did see the 24 days. 27 days, that peak that you see is 27 days, and then it dropped down during most of the year, and then we ended the year at 24 days in December. Again, it looks like, a lot of peaks and everything, but when you think about it, 24 days is still a little over 3 weeks, which is still very fast, and that's taking into account that there are some houses that are staying in the market longer, and so they're skewing the numbers a bit. Still, since 2012, it's basically been bouncing up and down between 2 and 3 weeks. And so very strong market we still see. The number of new listings, so this is, you can see the seasonal trends that we have in our area. So basically every January, it dips. December, January, people don't really want to deal with having their houses on the market. They are afraid of having buyers, not many buyers around as well. So they tend to wait until the spring. And so that's why you're seeing the ups and downs and up and downs. But in general, if you look back to the last 3 years, so January 2015, the last 5 years here, it's generally continued to stay about the same. Right? We've had some peaks and then it just goes right back down again. And so we're experiencing the same amount in terms of new listings. So conclusion for our local market, it's been still very strong in terms of values. The inventories are still very low. And it's perhaps, in some places, it's a little less competitive for buyers, which is good news. But at the same time, it's not like there's a fire sale going on everywhere. It's really can be very competitive. Most predictions regarding our market locally were that it would stay pretty much the same, and that's pretty much what we got. So it's kind of interesting to see that happening. And then months of inventory, again, this is how long it would take to be able to sell all the houses that are on our market. And that bar in the middle, the darker bar that you see is for 6 months of inventory. So the 6 months is the balanced market. And again, as you see, we've pretty much been hovering around 2 months of inventory since 2012. So, and that has not let up. In December of last year, we were at 0.9 months of inventory. So even though, you say, okay, the seasons and whatnot, still that's very low.